Hello, my name's James Gerrish, and welcome to the Market Matters webinar. Thanks for joining us. Today we're going to run through some of the key things we're looking for in the markets, where we think markets are going to go in the short term. I want to give you some interesting buy ideas, some interesting sell ideas, and some interesting, or what we think is more interesting, around the way we're being active around our portfolio. Just give you a bit of background. I'm the primary contributor here at Market Matters. I write the content. We've got a team of guys within Market Matters thereafter, but I'm the primary contributor. I'm also an advisor up at Shaw and Partners, and we've got around $12 billion under advice. So I'm in the markets on a daily basis. We deal with fund managers, we deal with retail investors. I run a team of guys up within Shaw and Partners. So I've got, I guess, a little bit of a unique view around what's happening in terms of fund flows, what institutions are looking at in terms of the market, and how they're positioning in terms of the market, and we overlay that around our retail holdings, etc. So a bit of a unique insight, and I'm going to try and give you some of that insight in the market today. On the screen in front of you is one of the biggest tectonic changes, I think, that we're seeing, and we need to be really conscious of in the market at the moment. We've been through a very prolonged period of strength in the market. So I'll just grab the S&P 500 quarterly chart up there to show you. So bull market since the GFC low has lasted going on 9 years. So, you know, if you look historically, bull markets like this typically have corrections, and the correction is deemed something like a decline of 20% or more, and they have those corrections every 2.5 years. That's what statistics looking historically will show you. So we've gone almost 9 years without a 20% correction. So the first thing I think of at this stage, and framing how you should be looking at the market, is around conscious of that we're overdue for a correction. Now, I'm not saying we're about to go into correction mode now. I think the market is too cautious at the moment. I think cash levels are too high at the moment. We're not as euphoric as we probably should be in terms of getting to a market top. But I think from an investment standpoint, a sensible investor should be cautious. You should have your finger on the pulse. You should be looking for signs of market tops, and you should be, I guess, having a more open mind around your investments and how you're positioning in the market. So that's the framework, or the thinking we've got at the moment, where we think there's more upside in the market in the shorter term. We think the ASX 200 will be at 6,000 in the next couple of months. We think this 21-week range that the market's been trading in, a pretty defined range, a pretty tight range, will break. And because of the strong seasonality that we see at the back end of the year, typically, pretty much here in Australia, that's going to see the market up at 6,000. We want this euphoria. We want this, this fear of missing out, that fund managers go in there and spend some of the cash they've had on the sidelines, and that's when market tops typically start to play out. So the first message is keep your finger on the pulse in terms of the markets at this stage. I want to go back to this chart, which overlays. That actually overlays. That's not the right chart. This is the right chart. It overlays the 10-year US bond yields, so US interest rates, and it overlays with the orange line there that you can see on your screen there. That's the Dow Jones Industrial Average. The Dow Jones in orange, and the white bar chart there you can see in the channel between the blue and the red, that is US interest rate. So I think there's two important points to make here. The first is that interest rates have been declining for the last 30 years. On average, it's been declining 0.2% per annum for the last 30 years. So that's really supportive of asset prices. Low interest rates create higher asset prices. You know yourself, and it's you go and buy Sydney property at the moment. Obviously, low interest rates have fueled higher house prices, and the same is true in the stock market. So if you have low interest rates, you can afford to pay, or you can justify paying a higher amount for stocks, and that's certainly what's been playing out. I think that the interesting point at the moment is that if you look at the bottom of this band here, US 10-year yields are at 2.34%. So 2.34% for US 10-year yields. They're testing the upper extremity of this range. Bill Gross is a pretty well-known investor, started PIMCO, the world's largest bond fund manager, has now with Janus Henderson. That's a stock for those members that we have traded numerous times in the past. But he made a really good point at the back end of last week around this 30-year bull market in terms of bonds, which puts pressure on bond yields, is right at the top of the channel and could break. So if we have a situation, we think that's probably the catalyst. Catalysts are really hard to come up with or hard to foreshadow, because normally market corrections happen on some sort of surprise, etc. But I think that's one of the major things investors need to be conscious of in the next, or going forward in the next 6 to 12 months, is around rising interest rates. And I think that's something that from our portfolio at least, we're positioning for. And I'll touch on some of the areas that, or how we position for higher interest rates going forward. So that covers off one of the major points. I want to touch on what's happening here in Australia, because I just made the call that we are looking to for 6,000 in the next couple of months. So 6,000 on the ASX 200. I'll just get a shorter term chart that we can see here on the ASX 200. So you can clearly see that we've been trading in this range for the last 21 weeks. It's a pretty defined range. It's 56.29 low, 58.36 high. That's the range that we've been trading in for the last 21 weeks. That's a pretty abnormal period of trading. Markets typically don't trade in a range for that long. So we've sort of had one sector performing well, one sector dragging, etc., and that's what's kept us in a range. There really hasn't been a huge catalyst to push it out of that range. Although if you think about Trump and you think about what's happening in North Korea, etc., there's been a lot of things that could have prompted the market to go lower. So in a market that doesn't go lower on bad news, that suggests that it's a strong market. So if you think about the excuse that people could have made for selling stocks in the last couple of months, there was a lot of excuses there. But because cash levels are already high, because investors are positioning for a pullback, and we put our hands up. We're suggesting a decline back to 5,500 before the market goes higher. We've probably lost a little bit of conviction in that view. We probably think we've got more conviction in the fact that we think the market will go to 6,000 rather than it'll go down to 5,500 in the near term. So if you think about the ASX 200, we are positioning now for further upside into the back end of the year, and a break out of this trading range. It's been a pretty frustrating trading range over that period of time. When we think about the market, and we're calling the market high, but we're also calling a deeper correction in periods to come, so in the next 6 months or so. When you think about corrections and you think about what the market does in a correction, and actually there's opportunities to be had in terms of a market correction. Firstly, before the market makes a correction, it generally has a blow-off style top, so some pretty aggressive buying up into a major top, and money can be made in that regard. And we're certainly looking for opportunities. We've got stocks in the portfolio that will certainly benefit from that. And then when a correction comes, if you've foreshadowed it, if you've had the thinking that we are due for a correction, then you've got the mindset that you're looking for opportunities rather than looking for the exits when it happens. If you maintain high cash levels, it's really important when markets decline to make use of it. So maintaining high cash levels so that you've got the opportunity to buy weakness. That's a really important thing. Is maintaining high cash levels. We'll look at other products in the market, ETFs, etc., that benefit from market declines, and we'll write about those in Market Matters, and we'll have those in our Platinum portfolio. So it's a pretty good segue into our two portfolios. And I'm just going to have a quick, we'll get the AFR off, a quick look at those two portfolios. So we've got the Platinum portfolio. Obviously, that's a more growth-orientated portfolio. Both of these are actively managed. So the Platinum portfolio has more growth-orientated securities. We're a little bit more active around our allocations in that, and we've got a slightly different approach, so a reasonably high conviction approach in that. We're different from the broader market. We don't go out there and buy 30 stocks. We don't track the market. We try and outperform the market. We're high conviction investors, and we replicate that in our two portfolios. A couple of stocks in our portfolios that are worth noting at the moment. Before I say that, I just want to touch on the income portfolio as well. This is a reasonably new addition to the Market Matters stable. So the income portfolio has been going since July. We're up about 3.5%. In that period of time, so it's performing well to date. It's a portfolio that houses equities, hybrids, and other fixed income style investments. So I think it's, it provides that flexibility. It's actively managed in terms of your hybrid allocation, your fixed income allocation, and your equity allocation. So it's not going in there and buying your four major banks, a couple of infrastructure stocks that are going to see headwinds from higher interest rates. It's a little bit more unique than that, and we're trying to do something different in the market, and to date it's working very well, and it sort of tracks along with our strong performance we've had in the Platinum portfolio over a long period of time. I spoke a lot about interest rates going higher, and I think this is a really good segue into the banking stocks at the moment. I'll also touch on a couple of the infrastructure plays and more stocks that are not going to benefit or going to have a headwind in terms of higher interest rates. So if you think of banks, banks are a little bit on the nose at the moment in terms of the Australian banks. We've obviously had over the last 6 to 12 months higher, bigger regulation on banks, higher capital requirements, etc. There's been some things that have gone against the banks in recent times. CBA has probably been the biggest example of that, where we've seen, I'll just get the chart up there in terms of CBA, where you've seen the big premium to the other banks come out of CBA. And we're seeing that play out in the market today again. CBA is down there at 75.87. We own CBA in the Platinum portfolio, and we also own it in the Market Matters income portfolio. So we're reasonably keen on CBA at current levels. I think the compelling place to buy CBA was probably a month or so ago into that height of negativity. So I'm not suggesting now is the optimal time to buy it. But if you think about how we're going to approach CBA, $73 is the low, but we're going to be out of that stock if it rallies up into the 79 to 80 region at the back end of this year. While I've got that there, I'm just going to touch on seasonality in terms of using CBA as an example of the seasonality perspective here. I'll go on to a heat map in terms of CBA, and it really, CBA is a really good example of what typically happens at the back end of the year and why you should be more bullish or take a more bullish stance in the banking space towards the back end of the year. October, November, December is the most bullish period for banks. Obviously, the other three of the big four, excluding CBA, go ex-dividend over that period. So you'll see a blip on their seasonality in November, but on an accumulation basis, they all do pretty well over that period. On the screen that you can see, that's the 5-year trailing average. And if you go back further, you should look at data going back further than 5 years, and we certainly do that. And if you go back further, you also see that seasonality holds true. So in terms of CBA, and this is a good proxy for the rest of the banks, we think it goes higher into the back end of the year, but we are going to be taking profits on the back of that. So rather than buying and holding the banks, we're actively positioning around dividends for the banks, and we're actively positioning around our allocations in the banks. I'll just touch on Westpac quickly as well in terms of what we expect there, because this is probably a little bit clearer than CBA, given its strength at the moment. Given CBA's got some, they've got some issues around what the regulators are doing. They've got some issues around whether or not they're going to reduce their internal rate of return forecast, etc. So that's an interesting point as well. I won't go in it today, but it's worth keeping an eye on. Westpac, we have this in the portfolio. We've got it in the Platinum portfolio with a reasonable weighting, and the stock's actually done pretty well. We've got 10%, which is our second biggest holding. We've got a big overweight position in the banks at the moment. We're not saying rush out and go and buy the banks at the moment. We're happy with our positioning in the banks. At this point of time, we're more keen on the insurance stocks. They've been beaten down. The general insurers, Suncorp, probably to a lesser extent QBE, and these are things that benefit from higher interest rates. So I touched on stocks that benefit from higher interest rates, and the banks certainly benefit from higher interest rates. The insurance stocks benefit from higher interest rates. So I think it's around positioning in sectors that will benefit from higher interest rates. The US banking index is also an interesting one to look at, and we certainly look at that. We write about it on our weekend report, and we include it each week on our weekend chart pack. It remains bullish, and that gives us a degree of confidence to remain bullish on the banking space here in Australia. So in terms of Westpac, we're targeting a move back over back to $35 on a pre-dividend basis, and 34 around the 34 mark on an ex-dividend basis. So it goes ex-dividend around at the start of November. So that's what we're going to be conscious of, picking up the dividend. But again, we'll be reducing our banking exposure into strength. We won't simply be buying and holding the banks. And I think that's the approach that you've got to take in the market over the next little while. You've got to be more active in your allocations, and you've got to be open-minded in what areas of the market you're going to get exposure to. CYB was actually a really good example of the impact of higher interest rates. These guys, we had a large percentage. We had 10% of the platinum portfolio in CYB. We just took a really nice profit on half of the position about a week ago. But CYB has a huge amount of deposits that are on fixed levels of return over in the UK. This is a UK exposed stock, so we like the UK in terms of geography, and we like CYB in terms of higher interest rates over in the UK. So we took profits on half of our position there. We're going to let half of that run, but that's one of the major beneficiaries of higher interest rates going forward. In terms of stocks that won't benefit from higher interest rates, these fall into some of our three top sells. So I'll go into this straight away in terms of our three best buys, our three top sells. And there's also a couple of stocks that are in our portfolios, but we're going to be active around going forward. I was going to start with three best buys, but I'll go three best sells straight up, seeing as we segued into it. I talked about infrastructure stocks, so Transurban, Sydney Airports, APA, etc. Those are infrastructure bond-like stocks. So if you have a situation where interest rates are going higher and a stock is viewed like a bond, I just touched. If you go back to the chart that I looked at initially, you can see around what has happened to bond yields over the last little while. So bonds have been really strong. Bond yields have been low. As interest rates start to tick high, that's going to create a headwind for the likes of Transurban. The stocks that are viewed as a bond, and Transurban certainly like that. I'm not suggesting that Transurban is a poorly run company or it's got any major issues in terms of the company itself, but the external macro environment is going to create a headwind for it. And our view is that Transurban goes and retests the 2016 low back down there. It might seem scary at the moment, but back down there at $9.50, and I think that's what investors need to be conscious of. So we're at $12.13 today. A retest, if I go back out and look at a weekly chart, it gives a little bit more context around what 950 is, and it'll show you the run up that it's had. So we're only looking for a retest of that 2016 low down there at 945. Very plausible. I think that's one of the points I need to make around the index as a whole. A 20% correction in the scheme of this massive run up that we've seen in equity markets is a blip on the radar. It's not something to be scared about. It's not something to be overly concerned about it. They do happen. Corrections do happen. A crash is different. A crash is typically caused for a number of reasons, and markets drop 50, 60%, but it's caused by one particular sector that creates issues around the economy. We've seen the tech wreck. We've seen the GFC that was sparked by the housing sector, which obviously created a massive impact on the economy, and the market dropped substantially. We're not predicting that. What we're predicting is that the market has been strong for too long, and statistics suggest that we are due for a 20% correction. That's what we're conscious of in the way we allocate our money in the market at the moment. So TCL and Sydney Airports, two stocks that we have sells on. They're two popular stocks out there, and two stocks that we continue to think they're worth selling rather than buying at this current point in time. Sydney Airport's on the screen there at 7.25. The other, well, I was going to call it a popular stock, but it's probably not as popular as it once was. But Woolies is another one of our sells. We've got a downside target on Woolies of $18, which seems a little bit far flung at this point of view, but we're expecting it to go down and break the 2016 lows. Again, if I go a little bit further afield, you can clearly see over a 10-year period where Woolworths has come from and where we think they are going to go again. So we think they're going to retest this $20.30 low again and make a new low down around $18. You can clearly see that Woolies was up at $39 back in June of 2014. There's just no reason to be in this stock. There's major competitive issues. Woolworths has, the highest margins across of supermarkets businesses globally, from my understanding. And when a business has such high margins, they're ripe for disruption. And we've seen it in a lot of industries in years gone by. And I think it's a case where we'll see it in the supermarkets, or we're starting to see it in the supermarkets here in Australia. And I think Woolies has been reasonably strong, even though we've seen a lot of negative headlines around Amazon, etc. I think some of the other retailers, the JB Hi-Fis, Harvey Normans, etc., have been really weak, and they've preempted the entrance of Amazon, and I don't think that's been the case. So, you have Harvey Norman that tracks back down to a PE of 10 or 11, JB Hi-Fi that goes from a PE of 18 down to 13, 14. That started to price the entrance of Amazon, whereas Woolies is still on a really high multiple. It doesn't have growth. It's going to have pressure on its margins going forward, and there's greater level of uncertainty of what Amazon's going to do around groceries. So for me, I wouldn't be in that stock, and I would have Woolworths on a sell and a pretty aggressive $18 downside target in that regard. The other sell that I want to look at the moment just is around CNI, which is a Centuria. It's a property play. We've got it in the income portfolio. We bought it at $1.20. It's trading at $1.41. There's some corporate activity happening in that sector at the moment. A private equity-backed play has just come in and bought 14.9% of the stock at $1.48. We're at $1.41 at the moment. So I expect that stock, CNI, probably to track up to that high $1.40, $1.50 level. If it pokes its head over $1.50, we're likely to be sellers, and we're likely to take a good profit in that. They're raising capital at the moment through an entitlement issue. So we're, with existing shareholders able to top up their holding at $1.28, which I think is obviously a really compelling level. But if it does pop its head, we like the story. But again, everything's got a sell level, and that's how we, I guess, differentiate ourselves at Market Matters. We're not all about putting 100 buys out there. We're also really detailed and clear on when we're going to sell stocks. And I think that's a really important thing, particularly as the markets are approaching a top. You've got to sit back and look at those statistics around how long the market have rallied for, and it's got to make you a little bit cautious. It's got to, give you the reason to have a finger on the pulse. It's got to give you a reason to go out there and, you've either got to have your finger on the pulse, your advisor does, or the sources of information that you're relying on need to have their fingers on the pulse. And we certainly do here at Market Matters. So CNI, a sell, we'll look to sell that potentially above $1.50. I just want to touch on one that's probably a little bit left field, and it's only newly listed. We've put this stock or company into, it's a listed investment trust. I should be more clear about it. MCP, so it's a master income trust. They invest in corporate loans. They raised $500 million recently, or a bit over $500 million recently. They listed on Monday. Their issue price was $2. They're trading around $2.07, $2.08 at the moment. The NTA of that fund is still only $2. So I'm not sure. It's a bit of an anomaly in terms of perhaps there were some financial planning firms that haven't been able to participate in an IPO, that they have to wait on market to buy that stock and accumulate that security, so it pushes the price over and above what it's worth. we'll take that. But if that continues and it pushes over 210, 212, then we may look to sell that stock out of our portfolio, out of our income portfolio. We've got a 5% weighting at 5%. Let's get back to what everyone, I guess, wants to have a quick look at is in terms of buys. BHP we're reasonably active in, and we've recently sold BHP well above $27. It's trading at 26, 21 at the moment. So I think this is a stock that I wrote about it this morning in terms of the report, that we're in the banks, we're likely to be, we're bullish and we're overweight the banks in the near term, but we're likely to be on the sell side in the seasonal strength at the back end of the year. We were bullish resources. We had the biggest position in resources that we've had since Market Matters inception. Back in the middle part of 2017, from June, July onwards, and we've trimmed that, or we've sold out of those resource stocks at the moment, but we're going to get back on the buy side if we see further weakness in the resource plays. And I think that's probably likely. So I think we'll see buying in the banks leading up to their dividends. I think we'll see some weakness in the materials plays, and we'll use that relative strength in the banks and weakness in the resources to take money out of the banks and allocate in the resource space. And I think that's going to prove to be a reasonable trade. Global growth is picking up. I think that's going to be very supportive of resources going forward. I think you do want to be. I think you want to be in the resources space. It's just around they're volatile. They're dictated by commodity prices. Commodity prices are volatile. We all know that. So you need to be timing your entry and exit around the resource stocks pretty diligently. I did a video a couple of weeks ago with Peter O'Connor from Shaw and Partners, and he's a very well-regarded resource analyst. He put a very bullish view out of BHP. So he's calling $40 through the cycle price target. Now that's not a price target over the next 12 months, but you base it on the valuation derived, the components of BHP, what they can get to over the cycle, and it's easily a $40 stock over time. So from our point of view, we're about timing entry and exits. We're going to be in and out of BHP over that period. But again, we think it goes higher over time. We'll be taking some of our overweight position in the banks and putting it into the resource stock. So BHP, we have a buy below $25, so we'll be on the buy side or start to accumulate BHP below $25. In terms of, you can throw Rio in there. It's not on our 3 buys for this webinar, but you throw Rio in there. I've written about it recently. You'd be a buyer back below $65 or start to accumulate Rio $65. I guess the only issue with Rio is it's pretty much all exposed in the iron ore space. Iron ore has just dropped 25% in a very short amount of time. The energy space, the oil price actually looks more constructive at the moment. So we've just took a position recently in Santos, which I'll just talk about in a moment. So BHP buy below $25. CGF is the other stock in our buy bucket at the moment. And we're buyers below that. We actually have it in the portfolio, in the platinum portfolio. We've bought it recently below $12. We've only got a reasonably small weighting of 3% in that stock. And I say reasonably small of 3%. That's reasonably small for us. A lot of people have larger number of stocks, and 3% is probably a large weighting for them. But for us, we're reasonably high. We are high conviction, and 3% is low for us. We'll be looking to add to that position if it dropped down to the $11.50 mark. So $11.50 by CGF. We own it from below $12. We're enjoying a pretty good profit at this stage. But if it did drop below $11.50, we'd be on the buy side again. Interestingly, they are out with annuity sales numbers at the start of next week, so that's a really important thing to watch. The annuity sales volumes will be down on this time on the prior corresponding period because they're selling less shorter dated annuities and they're trying to sell more longer dated annuities. There's greater margins on the longer dated annuities, so they've made the decision to take a hit in terms of volumes of the annuity sales sold. but improve the margins on their overall book. And I think it's a really sensible thing that they're doing. Their growth is really strong, but they've made the call now to improve the quality of their book. And I think that's a really important point for Challenger. A couple of years ago, they were sell at all costs. They were all about volume and getting the volume of annuities through. Now they're looking to improve the quality of annuities sold and the margins they're achieving on those products that they're selling. An aging demographic. We all know what the demand side drivers for the sale of annuities are: aging population. If we're likely to go into a market correction at some point in 2018, that'll cause some panic amongst investors, and that'll drive more money into this safe annuity style product, which arguably, you're buying annuities when interest rates are low, so you're sort of you're locking in. You're doing what the reverse of what you should be doing right now. You probably should be thinking about locking in a home loan. With an annuity, you're doing the opposite. You're locking in a low return for the duration of that annuity, which goes against what you probably should be doing. So CGF, buy below $11.50. I mentioned initially in the general insurance space, so QBE and Suncorp. I'll start with QBE, Suncorp rather, because it is the largest holding across our portfolios. We've got it in both the income portfolio and the Market Matters Platinum portfolio. So I'll go down to a weekly chart in terms of Suncorp. It benefits from higher interest rates. That's just one thing. Suncorp benefits from obviously improving insurance premiums, and domestic premiums here in Australia are rising. And the other thing is that it's on an undemanding multiple, and they've got excess capital on their balance sheet. So over the next 12, 24 months, they're going to release some of that capital off their balance sheet. Expect some special dividends from Suncorp over that period. So I think a case where the underlying earnings are going to improve. They've got excess capital on their balance sheet, so the income is going to be strong, and the operating conditions in Suncorp, that the backdrop of their operating conditions, higher interest rates, etc., are going to help their investment returns, and that's why we like that stock. And we've got a big weighting. We've got 12% in the Platinum portfolio at this stage. We're up around 14% on the holding, so it's been a good one for us, but we retain the rage, if you like, on Suncorp. QBE's been a little bit more of a mixed bag in terms of the returns that it's generated. On the one hand, it's a big macro play. It'll benefit from a weaker Australian dollar as they repatriate funds back from the US into Australia. It'll benefit from higher interest rates because they invest a lot of the free float over in US bond markets, and they'll also benefit from higher commercial premiums over in the US and globally. Now, those commercial premiums globally have been sluggish. They haven't been as strong as what our premium hikes have been here in Australia, but they are starting to improve. So, the macro backdrop for QBE is positive. What's happening from a company standpoint, they just had a recent downgrade, which is disappointing, largely on the back of issues with their emerging markets business, etc. But I think we're retaining we're holding our nerve on QBE, and we'd be buyers of it. I think the market's got it wrong in terms of where QBE is trading at the moment. I think they will rally from here, and we'd be buyers of QBE down at these levels. Just a couple of active sells, and I touched on CNI and MXT, which are more sort of active sells, but we've also got. We recently took a position in Santos in the portfolio. We're buyers from $3.95. It's had a pretty good run up in the last little while. Santos is trading at $4.16 today, so we're sitting on a nice profit in our Santos holding at this stage, but our target is around the 440, 450 mark. We've written there just under 450 in terms of our target price there. So 416, Santos is looking strong. We've got a 3% holding in the Platinum portfolio. Again, it's a more active position there. The risk reward at these levels probably isn't there. But again, I think the energy space is an interesting one. It's an area that we will be more active in the months ahead. Regis Resources is another one that we've bought recently. Obviously in the gold play, and that's doing reasonably well. So 392, and this is probably going to be one of the stocks that we'll look to exit in the near term. We're only looking for a rally back up there above $4. We bought that only a week or so ago at $3.66. So there's a strong profit on the table at the moment, but we think a move up above $4 will play out. There's obviously some buying around in the gold space, particularly the more mid-cap gold space in the last week. Over in WA, the Labor government was trying to get through an increased royalties for gold miners over there. The Liberal government has now blocked that in Parliament, so that's not going to go ahead. Pretty much the more pure play WA gold producers were the hardest hit, and also the lower margin gold stocks were also hard to hit. So Saracens was probably the hardest hit one, but Regis was also hit pretty hard on the back of it. So they've now, obviously with the changing of that legislation or not getting that increased royalty through, they have a relief rally, and Regis has certainly done that. So it's a $3.91 at the moment. We bought at $3.66. We'll be sellers above $4 in terms of Regis Resources. We had throughout the webinar, we've been getting questions that have been ticked through to us. So I'm going to start there, and I'm going to very quickly go into those questions. But before I do that, I just want to leave you with their overarching message that we've got in the market at the moment. Markets are overdue for a correction. That's pretty clear that we've seen, and I hope you've got that message in terms of our webinar today. I doubt that correction is going to come from current levels. I think that correction is going to come from higher levels. Sitting on a trading desk all day, you get to see the flow of the market. You get to see how fund managers are positioned. You get to see how cautious or optimistic, bullish they are in terms of the market. That is the weight of the money on the Australian market. Retail investors are not the weight of money on the Australian market. Institutional investors are. And having an insight into that is really important around our positioning of portfolios and how we approach the market. So right now, there's too much caution out there, in my view, to see a market top. There's too much cash sitting on the sidelines to see a market top. Market tops happen when euphoria is high, when traders out there have got this fear of missing out, where they think the market needs to, the market starts to move higher. They've got high cash levels. Their performance starts to struggle, so they reluctantly put money into the market. That pushes it further, and that often goes into a major market top. And we think that'll be somewhere above 6,000. At some point in the next end of 2000, not in the end of 2017, but at some stage in 2018. So I think that's what we've got to be conscious of at the moment. The risk of a correction is there, but at this stage, opportunities are still presenting themselves. And I think that's what you've got to be very conscious of at the moment. Be vigilant in the market and have your finger on the pulse. Look for signs that markets are approaching a top. That's what we certainly do. We look at the weight of money, where they're going, how nervous, how optimistic the market is, the collective of the market is, where money's flowing into. We look at ETF flows as a really important thing around the themes in the market. I think overlay that with the biggest impact is going to be higher interest rates. We've had 30 years where interest rates have been going backwards. As I said before, 0.2% decline each year for those 30 years on average for the US 10-year bond yield. We're now likely to go into a period where interest rates are rising for a sustained period of time. I don't think interest rates will rise quickly, particularly not here in Australia, but I think they will grind higher over time, and that's going to have an impact on asset prices going forward. I think you've got to be more active in your allocations to equities, the sectors that you're in, the stocks that you're in, and I think you've got to retain a really open mind in what you're likely to do in your portfolio. That's what Market Matters does. I think we're pretty good at it in terms of our approach. The first question I've got now, I must apologise. I've got a lot of questions here. The first question was on Telstra. What our view on Telstra is. It used to be a really loved stock. It's obviously in the doghouse at the moment. The funny thing is, the NBN was meant to be a really positive thing for the telco sector. It was going to be this big churn event. It was all going to create a lot of new volume, etc. That hasn't happened. It's pretty much put a lot of pressure on the sector, and Telstra hasn't been immune from that. We own Telstra in both the Platinum portfolio and the Income portfolio. We think Telstra is going to trade between 340 and 370 a share. We've only just bought it recently, so we're not long-term holders. We've been and just bought it recently. So Telstra's 340 to 370 is the range that we see in Telstra. We're trying to be active around our allocations when it pays a dividend. So it still pays a very good dividend yield. They've obviously cut their dividend going forward, and Telstra's going into this has seen this change of its register. So holders that have been your traditional holders holding for yield, etc., because it's a super safe stock in inverted commas, have obviously seen their capital get eroded over the past couple of years. So there's that rotation out from those investors, and now they've guided to paying less dividends. They've guided to more reinvestment in technology and growing their business. So naturally, you have a turnover of the share register, and you think that's what's playing out at the moment. But I think that creates opportunities. So again, you've got to be active around your allocations to Telstra, but it's a stock I don't dislike the stock. I know the market hates it at the moment, but I think there's opportunities in that range between 340 and 370, being cognizant of the dividends. I just had a question around Bank of Queensland that reported today. We have Bank of Queensland in the portfolio. There's been a mixed response to its report this morning. Obviously, it came out and was pretty bullish in terms of the share price early on. It was up around 3%. It's come off those highs a little bit at this stage. So just to give you a quick rundown, they did beat earnings expectations by about 5%. Bad debts were lower than the market was anticipating, so that's obviously a good thing. They've announced a special dividend of 8 cents a share, and I think this is one of the interesting things with Bank of Queensland, Suncorp, and a few other stocks that are on our radar. There is the chance that they will start paying special dividends. They're carrying a lot of excess capital, etc. The capital requirements from global regulators and being enforced by domestic regulators probably haven't been as onerous as they could have been. So this return of excess capital is probably a theme that we're going to be seeing going into the next 6 to 12 months or so. So I think the outlook was good. What you want to see in terms of banks, you want to see volumes improving, you want to see margins improving, you want to see bad debts, and you want to see bad debts behaving, and you want to see adequate capital. And I think that's what we're seeing in all of these things in terms of Bank of Queensland. So that's a result. We've got 5% allocation in Bank of Queensland in the Platinum portfolio. We bought it at $12.75. Stock's now $13.13, so that looks reasonable. We only bought it back it's towards the end of August, so that's a reasonable holding there. Other questions that we've got is around Myer, which is, you know, we've talked about Myer a few times in the reports. Obviously, the Australian retailer is suffering. We've flagged it as a potential trade a few times, back down there when it makes new lows. So new lows in Myer is sub 70 cents. We actually wrote about it when it was as a buy below 70 cents. We didn't pull the trigger on it ourselves in our portfolios. But again, look, to me, it's probably all too hard. It's a high risk play. I think it's going to go through a transformation. It's cheap. It's got a new chairman coming on board. Solomon Lew's obviously got a major stake. He's pretty pissed off that he's down such a high amount of money in such a short amount of time. He's being vocal. The incoming chairman is now suggesting that is a furphy, that Solomon Lew, what he's saying is completely ridiculous. So there's going to be this agitation between a major shareholder and the company itself. Ultimately, the company will probably turn around. I don't know why Amazon doesn't come in and buy them and get themselves, turn the Myer stores into distribution centres, but that's probably a good idea. There's a lot of space in those Myer stores and a lot of people, so they can potentially turn those into Amazon distribution centres. But that is my idea, and I don't think retail is the space that I should be playing in. But it's interesting nonetheless. But to me, it's all pretty hard in terms of Myer. We had a question here, next one, in terms of our view on HealthScope. Where's it going? HealthScope is it's interesting stock. We bought it into this recent decline. We actually closed it for a small 3% loss, and that does show you that we are happy to take small losses on the Market Matters portfolio. We don't simply buy things and put them in the bottom drawer and hope that they turn around. So we did take a small 3% loss on HealthScope. It subsequently bounced up a bit after that. But our view on HealthScope is a little bit muted here. So we like the longer term story, the longer term demographical drivers of HealthScope. Private hospital usage is going up. They've got a really good relationship with the government, and the government is going to be more receptive to more private-public partnerships like we're seeing at the Northern Beaches Hospital. I think there's some long-term drivers for HealthScope going forward, but I think that these high PE stocks that are failing to deliver growth are at risk in a higher interest rate environment. So as interest rates go up, you can still justify paying a high multiple for a stock if it's continuing to grow earnings at a strong clip. And it gets harder to grow earnings as interest rates go up if it's not supported by underlying economic growth. So HealthScope right now, they're not going to grow. They're unlikely to grow their earnings much over the next 12 months. They're still on a reasonably high multiple. I think there's some concern around healthcare stocks globally. You look at the healthcare sector over in the US, they've been the driver of performance over in the US market, or one of the drivers besides tech over there. And I think they're approaching a peak. So I think you've got to read through that to HealthScope and be a little bit cautious on that stock. I'm not saying we won't go back in there, because it is, there's lots of reasons to like HealthScope, but at this stage it's a little bit too hard for us. And you can have a look. I'll show you Ramsay on the chart there. You can clearly see that Ramsay, when it was a much loved stock trading above $75, we got out of Ramsay up at those higher levels, which was obviously a good move. In hindsight, we've seen the stock drop down to the low 60s. And again, technically, Ramsay doesn't look overly appealing at this stage. I think you potentially be buyer of new lows below $60 to $55, but at this stage, 53, 55, there's no compelling reason to be there. Again, a high yielding stock that's been loved, it's well owned, etc. And something that we're probably standing aside from, and will only buy into more weakness. I've got a question here on NAB. What's a target to get out of NAB shares? Sell NAB shares into strength. So as I touched on before, and I covered this in length, we're sellers of banks in the strength. So NAB's trading at 31.94. We'd be sellers up around this recent high on a come dividend basis at $34. On an ex dividend basis, you probably take a couple of dollars off that in terms of selling out of NAB on an ex dividend basis. But up here, reaching these recent highs around that $34 mark is where we'd be out of a NAB position. And we've got a big position in NAB. We've got a 10% of the platinum portfolio in NAB. We're currently up about 3% on that position, so it's going reasonably well. We'll just keep an eye out for alerts of when we're trimming our NAB position or selling out in its entirety. I'm going to wrap it up there. I haven't got to all of the questions that got sent through, so I appreciate those that did send questions through. For those subscribers, we will be endeavour to answer the remainder of your questions in our Monday morning report. So thanks again for sending all of those questions through. I hope you got some insight out of this webinar. We will do more of these webinars. We're trying to increase our communications to clients direct from the desk that we do. If there's any interesting person that you'd like interviewed, we can potentially look at doing that. We're trying to expand our reach in regard to that. So I think we're doing a reasonable job of communicating with subscribers about putting our views out there and being clear on what we're expecting in the market. And I think that's the biggest message we've got to take out of this. We need to be super clear. We need to have a lot of clarity in how we're approaching the market, because we're coming into some pretty interesting times. And I think it's really important that you have your finger on the pulse in this period. So thanks again, and I will be back to talk to you very soon. Bye for now.